please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite our market master for the day. Tushar Pradhan, the CIO of HSBC Global AMC India, joins us now to talk about his expectations as we head into the big union budget and the earnings season. Tushar, good morning and Happy New Year to you. The one thing on everyone's mind is the possibility of a big fiscal slippage this time around because of a whole host of issues, including the way crude is surging. Do you think this would be a big deterrent for the market if it comes through?
Well, I think in the past, I think history just tells us that the stock markets actually does work on earnings and earnings alone. While all of the macro events and what happens to the fiscal situation is something of a concern, and the market does react in the short term, I'm not saying no. But if you see that we've had very record fiscal deficits, we've had near collapse situations from a government finances point of view, we have had very high interest rates. We've had very high inflation, and if you look at the compounded return of the equity markets through all of this period, this has been excellent in terms of the mid-teen kind of average return that we've got through then. So I think from a longer term perspective, fiscal slippage, and we're talking about a very, very marginal slippage, if any, and that's an estimate. One doesn't really know whether that actually going to come. I don't think the equity markets in the long run are going to be anyway affected by this.
Okay. Good morning, Tushar. But we're seeing this repeated resistance to 10,500. Will 2018, or at least the first half, be a period of consolidation at all? Or do you think it's there will be enough fuel in the earnings to take it past?
Well, it's an interesting question, Lata, because it's about which aspect do you focus on. So there is in any market valuation, and there is something supporting the valuation, which is the earnings. Now, last year we saw valuations actually take a re-rating upwards, which means given the fact that there was no earnings growth, you saw valuations continue to go up, which means the multiple is what actually has given you the return. So if you were to say what return did I get, and if you decompose the return of the market, most of the returns have come from the re-rating. Now going forward, the expectation is that the earnings are going to come back. Now there is going to be a midpoint between where the elevated earnings P ratio and the earnings growth actually do match and come together. If I were to be a theoretician and to say that the market always will trade at a fair value, that's somewhere where it is right now, which means that once the earnings actually catch up, you will find a normalization of the PE ratio over the last 15-year average. Now, having said that, normally, if you were to take this as theory, then you would think that the market will consolidate here. But the market is never driven by theory. I think what will happen, of course, is there is going to be some volatility. I believe that is because of all the news flow, which is so now, I would think, jammed up in the first half of the year. So you've got a budget coming up, everything to be curious about what the slippage is all about. You've got a lot of elections coming through the entire year as such that will always lend some volatility. There is external geopolitics all across the world, which also makes this a very interesting time to be. This doesn't really seem very benign as opposed to when we look at the last year where we called it a Goldilocks situation, where you had low interest rates, low inflation, high growth across all markets, and fairly benign external. I think this year is clearly going to be a lot different than that. So that would tend to point to the fact that maybe we will see about a volatility before it starts to balance out again.
In fact, that's what we're seeing in the market right now. It's just about treading in the green line. Looking pretty edgy, the screen, you'd have to say. So names like Tata Motors, ICICI Bank, HUL, Yes Bank, Infosys, all dragging the markets to the lowest point. And as Ashwini was also pointing out earlier, 10,500 seems to be a firm resistance now for the market. Tushar, I know we're talking about a lot of caution in the system, but the one positive data point that we got over the last couple of days is the way the manufacturing sector is picking up. The PMI data was strong. The commercial vehicle sector data was extremely, robust. Do you think this is something that's just a one-off, or is this something that could turn into a positive trend?
Yeah, again, a very interesting question, because if you look at what happened last year, the level of benign market atmosphere was not very visible at the start of the year or throughout the year. If you see, the news flow continued to bother people. So it was not as if there was euphoria. There was a lot of caution, and I think the caution persists into the new year. So this is again a very good sign from my point of view, where the hard data, like you mentioned, the PMI, the auto sales numbers, the hard data continues to be very supportive, but the market sentiment doesn't seem to be euphoric, which I think from a longer term perspective, and having been in the market long enough, is actually a positive. I would really be worried if everybody is excited, everybody is euphoric, and they think that it's just going to keep going up from here. That would make me worried. But I think currently the sentiment seems to be pretty cautious in the face of pretty strong hard data. So that's a good thing.
No, I take your point on that. Actually, you know, we did have a mutual fund cafe, as we call it, over the year, and all the four mutual fund guys sounded exactly like you, pretty cautious. So perhaps, therefore, the markets are determined to climb that wall of worry. But you know, Tushar, there could be genuine reasons for caution. Crude, for one, and of course, rising interest rates, because that also pulls up inflation. You know, actually, the Indian exports have not taken advantage of the global uptrend either. So you could pick holes in the Indian macro story. Is that a bother?
Well, there is always something to worry about. But I think your specific point about having to, you know, look at what's happening to crude, I would still think that that's not really a very large worry. Simply because of the fact that when we talk about global growth, what are we talking about? These rates are between 2.5% to 3.5%, right? So it's not as if the demand for crude is going to shoot through the roof. We still don't see private capex at a level which we have seen in 2007, for example, where crude prices shot off to, you know, beyond $100 a barrel and stuff like that. So in a sense, I think even if it does harden a little bit, I think we get worried about the percentages, because the low that the crude price has gone to was like somewhere in the 30s. So when we talk about 65 or 66, we're talking about a doubling, so 100% rise, you know. So, but I think in perspective, if you look at the average, take the inflation into account, then it's not really a very large rise in costs per se for most people. And on top of it, there is a huge amount of supply. If you look at the newer producing countries, and the people who are really producing crude at this point of time are very desperate to sell it. So the supply is you know, pretty strong, and it all really depends marginally about how much more demand you get. And my argument is that the demand that we are talking about is not really very significant. It might be sustained, it might be between 2.5% to 3%, but I don't think that's going to drive oil prices all that much, as we saw in the commodities boom 10 years ago.
Okay. Well, finally, Tushar, what would your positioning or relative weight be? Will it now shift in any fashion? If yes, to what?
Yeah, I think in the past, with lower interest rates and expectation of lowered inflation throughout the last year, there was a, you know, preference for holding financials and rate sensitives. I think there would be a little bit of, you know, kind of readjustment in that view, because of interest rates, which have hardened for a little bit, remain here or inch up, then that's a worry in that sector. However, you know, with the new 10-year coming around and the possibility that the issuances will start to ease off, once the fiscal picture becomes a lot clearer, I think India, you know, could see a possible leveling off of these rates. So which means, again, it's not really, in a sense, doomsday. I think there is a reason to get interested in the private capex story. I mean, we've talking about it for 2 years now. I think that this might just be the time to kind of focus on the orders which most of these companies have got, the kind of execution that we are seeing, the margins increase in the construction companies, for example. I think these are very early signs of a cyclical upturn, which eventually lead to private capex. So I think these are the kind of areas that I think one should start focusing on from what we were looking at for the last 2 or 3 years, maybe.
All right.